Welcome to Envision More. Here, we dig deep into the insights of first-generation wealth builders, unearthing stories of passion, resilience, and relentless vision. Your host is Wayne Wagner Jr., founder of Visionary Wealth Management. So sit back and dig in. It's time to envision more.
Hey, this is Wayne Wagner with the Envision More podcast. Thank you for joining us for another episode. Today, I have Ian Sloan, one of the partners from Chandler, Nichol and Sloan, a CPA firm in the Wilmington, Delaware area with us. And Ian and I are going to be diving into kind of tax strategy, tax planning. It is 2024, so we are trying to be proactive tax planners, not retroactive tax sufferers. So, Ian, thanks so much for being here.
Wayne, thanks for having me.
So, good stuff. So Ian, I wanted to kind of get some background from you in terms of like, how'd you get to where you are? You're a partner in a regional CPA firm. CPAs are always very busy, especially about 3 months or 4 months out of the year.
Sure.
But you guys seem busy year round with, business clients and that kind of stuff, but you didn't wake up one morning as partner in a big CPA firm. So what's kind of your journey to get to where you are?
Well, this was an opportunity that I had in 2003 to join the firm. At the time, they needed another associate in the firm, and I was looking for a job. So I originally had a background in economics. That's where I got my degree. Worked a little bit in DC prior to coming here, and then went back to school for my accounting concentration. That was so I could, of course, sit for the CPA exam.
Okay.
So I have been here ever since. Passed the CPA exam in 2006.
Okay.
And joined the firm as a partner in 2009. So what do we focus on? Tax is a big one. So obviously preparation. You have to prepare the returns. We do a lot of planning with our higher net worth small business clients, making sure they're ready for what they might owe in April, making sure things are set up correctly, make sure they've got the appropriate retirement plans in place, making sure if they're looking to purchase assets that might be depreciable to them, to their businesses, that they're making moves in the year that it makes sense for them. So we do that. We also do a good bit of advisory work with our small business clients, those that need kind of the high level bookkeeping and accounting needs. We're obviously available for them as well.
Okay, cool. So you said you did some work in Washington as an economist. Do we have you to blame for some things that happened in 2000 to 2002? Because you joined the firm in 2003, so I'm wondering if you were getting out of Washington after having caused the tech wreck. So
No, it's funny. My original degree was in economics. My career was not in economics. It was actually a manager role, an entry level management role. At a firm that did some heavy. They managed all the heavy litigation paperwork and
Gotcha.
digital distribution for law firms. Not really related to tax, but no, I had nothing to do with anything legislatively, but it happened since I graduated, no one on.
There you go. Good stuff. Well, and were you from the Wilmington area, or were you moving back home, or so you said you were in Washington? Where were you from originally?
I'm originally from here. I graduated from University of Delaware. Went to high school in Wilmington.
Okay.
Yes, I'm like so many of us Wilmingtonians, we end up back in Delaware one way or the other. So yeah, here
Gotcha.
I am.
Good stuff. All right. So, and the firm it's 3 partners, other associates at this stage. How big is the firm?
We're small. There's only 2 of us. It's myself and Susan Nichol. Jay
Okay.
Chandler, he retired in 2014, so he was the
Gotcha.
founder of the firm.
Okay.
And then of course we have our administrative support, Danielle. But we're small. We like being small. So
Right. Gotcha. And you and I have affectionately, I think there's 2 big themes with taxes. So anytime we're working with clients and their CPA, we're doing tax management. We're not doing tax avoidance, because one of will put you in avoidance, will put you in jail or someone in jail.
or at very least get you paying some very large penalties. Yes.
Right. So it's always tax management. We never do tax avoidance.
Sure.
And then, you referenced being proactive, planning and strategizing, looking to match deductions with years of high income and those kinds of things. Um, and I know that you and I have also had some clients where we've done some creative things with things like deferred comp plans and defined benefit plans and things like that for clients. Maybe
Absolutely.
maybe we get into that a little bit today as we're talking. So
Well, sure, absolutely. I mean, when it comes down to where are your best tax benefits, they really do lie in these qualified retirement plans. Now, it's never a one size fits all with that, from the individual and from the business standpoint. Obviously, we have traditional IRAs, we have Roth IRAs, we have defined benefit plans, we have 401ks, temp
yeah,
IRA, simple IRAs. There are a lot of different tools that can be sized up with your retirement needs, your retirement funding desires. What who else is involved in your business as far as employees? A defined benefit plan has very high limits up to $275,000 a year. Those are massive, massive deductions. Can every business put one of those in place? No, clearly not. If you've got
right,
50, 100 employees, 1 year of it'll bankrupt you. So the tax
right,
savings
right,
is going to outweigh the fact that it's going to render your business insolvent. So those sort of plans don't work for everybody. They work for certain types of consultants, certain types of doctors, attorneys, high earning professionals that might have a smaller staff. And then ultimately what a tax deduction can give them a large savings.
yeah,
So we all end up a lot of times in these 401ks, either through our employers. If we're an employee company, we don't really have a choice
right,
as far as what's available to us. And of course, from the employer side, they're great as well because you have that $23,000 contribution limit. It isn't subject to earned income limitations, but you have to have 23,000 earned income, obviously, to
right,
put it in there.
yeah.
But it's not limited by 25% of your earned income. So, it can potentially hurt that ability to contribute. So, yeah,
Yeah. Yeah, I think, well, and part of what what we walk clients through when they're becoming self-employed is, first and foremost, I'm a big advocate for maxing out the 24% tax bracket. So if you're married filing jointly in 2024, you can make up to about $383,000, and the top end of the tax you're going to pay is 24% at the federal level. The
sure.
challenge I see is that we'll have, like, I just had a conversation with the son of one of our clients, actually this morning, and he is starting his first job. It's a great job. He's making $68,000 a year, and he's going to put money into his retirement account.
Sure.
And he's
Good.
asking me, so I'm told I'm supposed to put money in and take the tax deduction, put the money in pre-tax, because in retirement I'll be in a lower tax bracket.
Right.
I said, "Bud, you're in the 22% tax bracket. So everything, as a single person, everything over $47,000 is taxed at 22%. And then everything over $100,000 can be taxed at 24% up to $170,000 as a single person. By the time you retire, Social Security is going to be more than $50,000 a year for you. And so they are going to push you into the 22 to 24% tax bracket just with the money they're giving you during
Right.
retirement. So the idea that you're going to be in a lower tax bracket at retirement is nuts. You, the best case scenario, you will be in the exact same tax bracket you're in today. Now the question is, you are young, you're 22, 23 years old. You've got potentially 5 or 6 doubles on this money that you're going to put away this year. So
Right.
let's just be aggressive. Let's say you put away $10,000 this year. 5 doubles means that 10,000 is worth $320,000 by the time you retire.
Right.
6 doubles means it's worth $640,000. Now, would you rather pay 22% on $10,000? Or even if I did give you a better rate, let's say we somehow miraculously got you into the 12% bracket. Do you want to pay 12% on 640,000?
Right. Well,
Right.
and
So I'm a big advocate for using the Roth contributions, the Roth IRAs, the Roth 401ks when you're in those lower brackets. And I'll frequently find, have clients coming to me saying, that we want to save every penny of current day tax we can. I'm like, that's not the goal. The goal should be lifetime tax liability, not necessarily this year's tax minimization.
Absolutely. And, we're currently under the tax rates from the 2017 Tax Cuts and Jobs Act.
Yeah.
So they are historically low rates. And what do we know about those? We know that in the absence of any congressional action, they're all going to expire at the end of 2025. So it's not just the 22% bracket, it's the 10, 12, or 24% rather, the 10, the 12, 22% bracket,
Yeah.
which are compared to the prior tax rates, they're very long brackets.
Yeah.
And you also get this massive standard deduction, 14,600, I believe, in 2024. If you're single, 29,200 if you're married. All of these items are set to expire. So it's rate and then everything that leads to you being taxed at those rates, they create lower average tax rates. So the marginal rate's important, but so is the average tax rate. We're in an election year. We don't really know what the makeup of Congress and the presidency are going to look like when they do start to negotiate tax reform. If they negotiate tax reform, and I think they will, regardless of what that looks like. I think there will be an attempt to come to an accord with all of that, but we can't guarantee it. As we talk about Roths, Roth IRAs, Roth conversions, you go back to 2010. 2010 was the year that $100,000 adjusted gross income cap came off that Roth conversion. So it used to be an item that you kind of used in spotting certain specific circumstances, but it really didn't work for a lot of your clients because what happens is they were over the income limit. It just wasn't something that was available. If you went back and listened to the people that were that knew about taxes, knew about creating legislation, almost everybody was unanimous that AGI limit was going to be put into place, potentially permanently. It wasn't going to sunset. And it never was. And then it was never revisited. So my point with all of that is obviously in 2025, I do believe something is going to happen. Some portions of these tax cuts will persist, but I don't know if all of them will. But we've also had times where we thought they wouldn't expire and they do. So, you make very good point that, yeah, you have a lot of opportunity to put into Roths that you might not have. It's going to cost you a lot more money to put into Roths going into the future.
Yeah. Well, and you just brought up two things. One is if Congress does nothing and the current tax brackets expire, we automatically revert to pre-2017 brackets, which are substantially higher than what we are living with today. And then the other side of this is the question of the Roth conversion income cap, which is, we've had this kind of panacea of environment where we can really convert, regardless of your income, we can convert any amounts of money from IRA to Roth IRA. And we've been doing a lot of that for clients, generally trying to manage them into the 24% bracket. Or maybe they've got $150,000 worth of income, but that still gives us about $230,000 this year of room up to the top of the 24% income bracket for married filing jointly to do Roth conversions. So we've been doing a lot of that for clients and triangulating for them. But you're absolutely right. If they reinstitute an income cap on that, it's going to make Roth conversions much more challenging in the future. So that would say to me that this year, 2024 and 2025 are high profile years to do something about your Roth conversions.
Absolutely. Absolutely. We can only work with what we know. And we know we're going to have these tax rates through 2025. Obviously election year, I don't think they're going to be reforming the tax code for next year.
Right.
So it is an opportunity, and it's a rapidly potentially closing opportunity.
Yeah.
So, yes, the other thing you have to be aware of course, when you do these is, you've got a 5-year qualified holding period with those Roth. Now, I hope your clients and my clients have no need to tap them at any time, and the 5-year qualified hold period is a detail.
Right.
But when you start contributing to Roth, if you hadn't had a Roth before, you have a 5-year qualified holding period, even if you reach 59 and a half.
Hmm.
Where if you draw from that, those earnings, if there are earnings, are subject to a 10% penalty. So, you've got to certainly think of that. The other thing that I do like to bring up when Roth conversions come onto the table is prior to 2018, excuse me, you could revert those. So if you had a market drop of 25% after the conversion, you could always put it back. And you wouldn't have to, of course, pay tax if you, of course, have taxable. If you pre-tax funds that you are moving to post-tax funds, you can't reverse those. So you always have to be aware that when you make those, they're done. This is an irrevocable decision that you've made.
Right.
So it's the beauty of hoping we can all time markets when we do these conversions. It's great, but one of the things I did by clients is if you're considering it, maybe you wait to a part of the year when we have a drop in the market, if we have a drop in the market. I mean, of course, that's an if.
Right.
Because again, you don't want to start with $100,000, convert it, pay tax on it, and have it worth $55,000 a few weeks later. I mean, it just ends up being a longer runway to recoup the tax dollars you're going to have to pay on that.
Right. So that you're bringing up another important point, though. So that you've got the Roth conversion window, the 5-year kind of clawback on earnings on the Roth. Is that for the specific Roth account that is currently open, or is that as long as the client has had a Roth, regardless of where it's sat?
The client has to have a Roth open already. Yes.
So a Roth IRA open, whether it was at Fidelity or Schwab or Vanguard, is secondary. So if they
Exactly.
okay.
Exactly. Yes.
Does Roth 401k assets count as opening a Roth IRA?
No, they don't.
Okay. So it would be a logical thing to say, okay, even if we are putting Roth IRA or Roth 401k dollars away inside the 401k and or putting after-tax money into a 401k for future use, conversion to a Roth, still makes sense, which we'll come back to that one in a second. But it still makes sense to go open an actual Roth IRA, even if you just put $100 in it, because now the 5-year clock is ticking.
Yeah. I mean, it's one thing I will say about Roths is open them early if you're able, if your company offers them, and that's more for your younger clients.
Mm-hmm.
Like, get them open, start that clock ticking.
Yeah.
And here's the thing about Roths: they're massively flexible plans. Obviously, we're thinking retirement for most of our clients, but they can be used for more than that.
Mm-hmm.
They can be used for qualified education expenses. If your kid's going to college, they can be used to pay for their college tax-free. Again, if you've met that 5-year qualified holding period. They can be used for certain emergency qualified medical expenses. They can be used for first-time home purchases up to $10,000 out of that plan. So, obviously we're thinking about end-of-life planning, retirement planning with those, but there are a lot more tools a lot more uses for them. And the other thing about Roths is we talk about the holding period, but if it's non-converted funds, let's leave the converted funds out of that. If it's just you're funding your Roth IRA, you put $500 in there today, you could take $500 out tomorrow tax-free because you base this in that account. So, for your younger, more cash kind of strapped, frankly, I mean, we were all 22, 23, 25.
Yeah,
sure. They can almost function like a savings account. I would say savings account because they're invested in equities, but you can always get that $5,000 contribution back if you've been a purchasing expense and you're not paying a penalty on it.
Yep. No, that's good. And we're doing a lot of work with clients as their kids get into their careers with client gifting. So having the mom and dad gift money to the kids. So once the kids have got enough earned income to be able to do a Roth. Because a lot of times when kids are in high school and college, they're not earning enough income to be able to put $7,000 away.
Of course.
Even if mom and dad gave them the $7,000, but we have a lot of clients today who are mom and dad are gifting money to the kids, and then we're working with the kids and setting up the Roth IRA for the kids and then managing that for them. And like I had a financial advisor one time say, "You seem to do a lot. You seem to like know all your clients' kids." And I'm like, "Well, when you talk mom and dad into giving them money, they generally are not afraid to hear from me." So,
Well, and it's also an opportunity for some multi-generational tax planning.
right,
Because when we talk about wealth, we talk about taxes. You do need to start thinking about the next generation. Certainly, when mom and dad are either on the track or have achieved a certain amount of assets, that they don't necessarily need additional assets to fund their retirement.
right,
So, we currently have an absolutely mammoth estate tax exemption.
hmm
But that is going to expire at the end of next year.
right,
So, we may be working at a much lower figure. So gifting, I mean, that comes into that classic gifting question. Gifting to your children, that 18,000 per year per person. So between husband and spouse, you give 36,000 to each child. Create that opportunity if you can fund that tax deferred. And of course, Roths, unlike your traditional IRAs, have no required minimum distribution. I mean,
right,
that could theoretically be something that passes to their children without ever entering the taxable economy.
right,
So, Roths for young people really leverages time to their benefit. Thing is about it is, and the one thing that I like to talk about is the legislative uncertainty with all of this. When they enact Roth and these legislations that expand the accessibility to Roth 401ks, Roth IRAs, Roth conversions, the one thing we have to remember is the people who pass those laws are collecting tax dollars now. So when these assets stay outside of the taxable economy for decades upon decades, these people have moved on from their career. They've retired. Maybe they unfortunately passed.
right, right.
So I I believe at some point it will be a legislative concern. I don't know when. It
Yeah,
isn't presently one. But again, what could they do? They could have RMDs from Roth someday in the future.
yeah,
They could say the earnings are taxable. I don't think so, but they could. Maybe they could do whatever they want. It's Congress. Congress has a great deal of ability to
sure,
pass tax laws. So,
yeah,
just a lot of things to think about. And of course, you can end up with so many data points about potential tax problems that you become paralyzed in inaction. But certainly, just a few things for your listeners to think about as they think about Roths and contributing to Roth.
yeah. Well, I have a few different things I want to come back to, but you've just touched on something. Taxes will continue to get more complicated. We're going to
Probably,
continue to need CPAs.
I hope so.
And I think the statistic is the median age of a CPA the median age for CPAs is that they've already qualified for Social Security.
That is the statistic I'm seeing. The last one I saw, which was from 2019, is we have 36% fewer people sitting for the exam, and
Yeah.
even of those, fewer are passing than just a few years prior.
Yeah.
So yes, there currently is our profession is I don't want to say it's dying. There's a real need for us, but
Yeah.
certainly the pipeline is not what we'd like it.
Yeah. Yeah. I would agree with that. I think it's so difficult to find somebody who is, well, and especially if you're looking beyond just tax preparation. There are people who will do tax preparation, but those are the jobs that I do think AI is going to interfere with, right? So at some point here, for the simpler returns, AI will be able to replace some of that manual labor for the tax preparation, but the tax strategy, the ability to, I mean, I compare it to the internet, right? The internet is going to change the world. People are going to make better decisions because they have access to so much more information. When the reality is, access to so much information leads to conspiracy theories. It leads to analysis paralysis. I can't make a decision because I don't know which right decision to make because there's so many possible right decisions to make. Um,
Sure.
and so I don't know that, giving more information or more, data to, with regard to AI coming into the play, into play. I don't, wisdom is still going to be wisdom. Like we're still going to
Sure.
need people who have got a little gray hair and have been doing this long enough to have made mistakes to, come at our situation and say, okay, here's how we fix this.
Absolutely. I mean, you've every time you deal with a client, a new client or an existing client, you do have to understand what their willingness is to ensure that these transactions are done correctly. Are they keeping appropriate substantiation to support what they're doing? That they can go in front of the IRS Department of Labor and present, the subcontractor versus wage
Mm,
elections decisions that they've made
right.
with the people that are working in their business. Are they putting the right retirement plan in place? I mean, these are things that seem simple, but they're not because the answers are diverse. And sometimes you have clients who own multiple businesses. One of those businesses may need one kind, and another might need another. So
Right, right. I'm raising
yeah,
my
well,
hand
yeah. So
because I'm
oh, but
someone who
yes,
has many businesses.
Exactly, and some of those businesses aren't eligible for retirement plan contribution, I
Right.
presume, for you or for anybody else. So
Yeah.
so there's a lot of little items you have to navigate. There are a lot of little taxes now we have to navigate. A lot of the decisions we make with tax now impact items outside of tax, which sometimes is a source of irritation because we prepare tax returns. We're trying to comply with the Internal Revenue Code, and then of course with any relevant state code. But now those tax returns are used to get mortgages. They're used
Mhm.
for our clients to get financial aid, either for private schools or for college education. They're used for student loan payments. They're used for just a myriad of transactions. Oh, IRMA is a good one.
Yeah.
Medicare, your Medicare premium is based on a modified adjusted gross income calculation.
Yeah.
So when you talk about things like Roth conversions and realizing capital gains, you've got some large capital gains in the portfolio. They can impact all of these items potentially negatively. Maybe if you're going for a mortgage or a loan, it's to your benefit. You've got more income. But in reality, for a lot of them, it's going to hurt certain aid packages that are given either from private entities or the government, or as well as premiums that you pay on your insurance. So,
Yeah. Well, and you're reminding me, so I'm writing the book Envisioning More, and I'm working on a tax chapter right now.
oh boy,
There's big disclosures. I'm not a CPA. This is not specific tax advice for your situation, all that kind of stuff.
well, it's so the hard part about writing anything about taxes, it's a moving target.
Yeah.
Secure Act 1.0 and 2.0 passed. I mean, we had pundits saying we'd never pass tax reform again after January of 2013, retroactive to the prior year. And we've passed, obviously, 2017 Tax Cuts and Job Act through the Budget Reconciliation Bill, massive tax act. But the Secure Act 1.0 and 2.0 in recent years.
Mhm.
Every single one of these reform bills that went through for COVID relief, they had major tax provisions in them. So,
Mhm.
it's like you write a book and what you say today is true and
Right.
tomorrow it isn't.
Right.
I think back to this brief period of calamity in 2020 where they passed the CARES Act and there were a ton of benefits to small business owners. And I remember you would have to check or who is it? The SBA's website because they did I think it was 12 separate revisions of all the guidance on this.
Mhm.
And I had a client read something one night, had a call scheduled with me the next day. And that morning at 7 a.m., they had published new guidance that actually refuted what he was coming to me about with one of these programs. So,
Incredible.
it's yeah, it's well, that was not fun. Um, and we usually don't do it that quickly, but yeah, I mean, at any given time, the Ways and Means Committee is working on some bipartisan reform bill
Right.
that secures up retirement. And that's Secure Act 1.0 and 2.0 is about ensuring Americans can retire better. More accessibility, employer-sponsored plans, different RMD rules depending on when you were born. I'm sure we can also touch on the 10-year IRA distribution rule at death.
Yeah.
Major changes that killed some provisions that we just had grown accustomed to. So, But yeah, fun things to consider in the chapter of your book.
Yeah.
That'll be the date it's published, and then all the revisions that happen
Yeah.
shortly after it. So
That you just hit on a couple of things I was writing about yesterday though, and that is the RMDs,
Mhm.
which by the way, Roth IRAs have RMDs as well, or not? No, they don't have RMDs.
No, no, no.
Do they have mandatory? Does the mandatory 10-year distribution after death enforce for Roths?
Yes, yes,
No.
they are.
Okay.
But it's as we talk about the Roth versus traditional. Um, One of the things that now is coming into this discussion is this after death R&D period, because your beneficiaries and the IRS just clarified that 10-year distribution period. I think it was a couple weeks ago. Because you have 10 years to evacuate that account, right? It's taxable income to that beneficiary.
Yep.
And you kind of have to think about the ages when your average American is passing. Usually they're in their early 80s, maybe late 70s, maybe a little older. But the point being is the adult children who are the most likely beneficiaries, they're in their peak earnings.
Yep.
They're in their 40s, they're in their 50s. So they're
Yep.
probably paying their highest effective tax rate. And now you used to be able to take your parents' IRA over life expectancy, your life
Mhm.
expectancy, not theirs.
Yeah.
So you had this massively long deferral. So the tax hit in most situations, unless you had $20 million in your IRA, and what a wonderful situation. No, um, was minimal year after year. Now you've got this 10-year evacuation period that's happening with a generation that's relying on pensions like their parents did. They are relying on their IRAs, on their 401ks. Do you have a real tax problem potentially for those beneficiaries? So the Roth eliminates a lot of that income tax problem in that it is non-taxable to those beneficiaries. So if they are making four or five, $600,000 a year, they're not
Mhm.
worrying about now this 10-year on $1 million IRA. They're adding $100,000 a year, maybe $1 million in the final year,
Yeah.
potentially a top or near top bracket. So
Yeah.
and of course that doesn't include estate taxes. State taxes are involved, or those IRAs could potentially be subject to it. But from the income tax, look, if that's a problem for you, you hopefully you're not getting your advice from a podcast. You're sitting down with a professional,
Right.
myself, or one of my colleagues. But hey, I just like to throw that disclaimer in there.
Yeah. Well, a couple of things back, related to these qualified plans, because I was actually touching on the idea that it's the tax section I'm writing on is about 401ks, and I'm talking about Roth conversions, using Roths as long as you're in the 24% bracket, things like that. But
Sure.
um, I'm specifically writing about thinking about people who have got millions of dollars in their retirement accounts. The
Mhm.
typical corporate executive who retires feeling really wealthy with 3, 5, $7 million in their retirement accounts, and only to that every dollar they're pulling out of there is now taxable during retirement. And
Right.
if let's say you have two kids and you've got $5 million in your retirement account and you die, each of the kids inherits $2.5 million that they now have to deplete over 10 years. So at a minimum with zero growth, they're pulling $250,000 a year out.
Right.
While, as you correctly point out, they're in their peak earning years. So they're in their peak earning years, and like that $250,000 is not going to get taxed, or excuse me, is going to get taxed at a much higher rate than what you were being taxed on when you put the money away.
Right.
So
Right.
again, back to the conversation about, using Roth IRAs and Roth 401ks and Roth conversions to manage lifetime tax liability as opposed to trying to minimize tax in any one single year.
Well, absolutely. And, it's the lack of RMDs presently, it just gives you a longer runway for accumulation in those
Right.
roles. And that's your entire natural life. And then again, that 10-year runoff after your life, as your beneficiary leave that off, there are really, really long periods of deferral for these accounts that the traditional IRA, the traditional 401ks might not have.
Yeah.
Well, they don't have, they don't have and probably won't be changing. So,
Yeah.
um, probably, who knows, I would say that we've seen some
One of the
change
other
there.
things I was thinking about was as our people are in their peak earning years, frequently their kids are going to college at the same time. And so
Right.
let's say you are going to leave your kid $2.5 million in an IRA, and their kids, your grandkids, are going to college. Now, let's say the peak earning for your kid is not 4, 5, 600,000 a year. Let's say it's 125,000 a year, where FAFSA now comes into play, where they're filling
Right.
out FAFSA forms, and the kid and the grandkids are qualifying or not qualifying based on household income. And they now have to pull out $250,000 a year out of your IRA to meet, to deplete this thing in 10 years. And they're going from 125,000 a year to 400,000 a year.
Right.
And which they're jumping from the 22% bracket and actually the low end of the 22% bracket all the way through up to a 35% bracket because of
Right.
the distributions. And the grandkid is now not qualifying for help that they otherwise would have qualified for based on the FAFSA evaluations. So,
Yeah, there's a lot of little, I don't want to call them nightmare scenarios, because obviously from an economic perspective, it's certainly not the worst place to be.
right, right.
But a lot of potential pitfalls when you talk about that new 10-year runway on those inherited IRAs. Now, the one thing I will say is that if they're a minor child and that happens, they do get the life expectancy on those inherited
Mm,
IRAs. So we have a few other spouses can take them over life expectancy. In most
right,
cases, the
right,
spouses is taking that as their own,
right.
and then just allowing it to defer until they reach their R&Ds, just like a normal IRA. But there are some exceptions to that. But yeah, there are some not attractive scenarios that your earnings can effectively spike from them that you're not expecting.
Right. No, that's good. It's good stuff. I wanted to go back to tax law changes and 401ks, because I know one of the things we've done with clients is we're in the top tax bracket is we'll have them max out their 401k contribution on a pre-tax basis, and then they'll have their company match. But there may still be some room to put some after-tax money in, and we'll have them put after-tax money into the 401k until they hit the Internal Revenue Code, contribution cap for the year, which
Sure.
because like 68,000 or something like that, something in that range. Um,
Mhm. 69.
so,
Yes, you're very close.
so, um, so, yeah, well, and then under current law, the reason we've been doing that is because under current law, we can convert those after-tax contributions into a Roth IRA. But again, that's under current law. And as you pointed out, that's something that could be on a chopping block or negotiable on a going forward basis. So,
Sure, absolutely. And the other thing that I just want to add when you talk about considering these conversions, uh, is you talk about the federal tax rates, but you always have to consider your state rate as well. If obviously we have no income tax states, not all states tax those conversions.
mhm,
Most of them with income tax do, in my experience. So yeah, again, you just have to add 3, 6, 8, 9, whatever your applicable
13 in
state rate is.
California.
13 in California. Well, right. I mean, I'm sitting here in Wilmington. I could practically walk the Pennsylvania border, so I'm in a 6.6% state.
Yeah.
That's a 3.07% state.
Yeah.
So it really does it does depend on the state, because it does get figured into what you're going to have to take off that the top as you look to continue to build those
Right.
assets.
Well, and Pennsylvania is a 3.07% state, and they don't tax distributions from 401ks and IRAs because they
Right.
tax it on the way in.
Yes, Pennsylvania
So,
is one of those fun states that likes to what we call decouple from a number of federal provisions. One of them is the Internal Revenue Code. They'll tax those retirement plans going in. They tax those 401k contributions going in. So they tax their usually the Medicare wages. There's other exclusions and items. They recalculate everything. So it's an interesting state from that perspective. But Pennsylvania also, the one thing you have to remember is Pennsylvania also has an estate tax. So they
mhm,
lure you in by not taxing retirement plan contributions, your IRAs, the conversions, the pension. But when you pass, you are potentially, well, you are, if you have assets, you're going to pay some state tax.
okay. Any idea off the top of your head roughly what that is?
It depends. It depends if it's a lineal descendant, if it is
Okay.
skips a lineal descendant, or if it is a non-family descendant. So there's
Okay.
multiple rates.
Gotcha.
So yeah.
Gotcha. No, that's good stuff. Ian, where else should we go on this? I know that we've spent a lot of time on qualified plans, and I think there's a lot of meat here, a lot of kind of tax hacks to for our listeners here. This has been good so far.
Well, good. And that's the thing. There really are. I mean, there's just it's gotten more complex because these conversions are available to everyone.
Yeah.
And one other thing I'd like to touch on with conversions, and it's because I do think this is a really nice tax act is, um, if you do not have funds sitting presently in a traditional IRA and you're above the adjusted gross income limitations to to contribute to a Roth, you can contribute to a non-deductible traditional IRA and convert that hopefully on the same day or next day. And the
Mhm.
only thing that would be taxable would be earnings on that account. So if you put your
Mm.
$7,000 in today, convert it tomorrow at
Right.
$7,000, there's no taxable income.
Yeah.
But you cannot have funds in any traditional IRA or a SEP IRA or a simple IRA. You can have funds in a 401k. 401k does not count towards that.
Okay.
Now, let's say we're going to keep this simple because I have to do arithmetic on the fly. Let's say you have $5,000 in pre-tax funds in an IRA, and you want to contribute 5,000 to a non-deductible IRA contribution. So now you have $10,000 in funds.
Mhm.
So let's say you say, I want to convert 5,000 of that. Well, what you cannot do, and everybody wants to do this, right? And clearly you don't want to pay the tax. You cannot designate that non-deductible contribution portion to the conversion. So you can't say, I'm only converting the non-taxable component. You have to prorate the two.
Okay.
So you've got that $10,000 in there, you're converting 50% of that conversion is going to be taxable. So you're going to have a $2,500 liability. So, some 401k plans allow you to put your qualified funds into their plan, either from your old employer or from your IRA. Those are ways to avoid
Okay.
that tax hit. And again, you probably work with people where they're going to pay that tax hit anyway, and it makes sense. A lot of times they're younger taxpayers because again, you're looking at that 50, 60-year deferral period. But yeah, that's one thing with those conversions. It is a nice little tax benefit that hopefully some people are able to use.
Yeah. No, that's good. That's good. The deferred comp plans, those are, you mentioned up to $275,000 in contributions. I want to touch on those for a minute because we do
The
have,
defined benefit
I'm
plans.
sorry, yeah, defined benefit plans.
No,
So,
no,
yeah, sorry.
a lot again.
Yep.
So many different plans for
Yep.
deferral. Get them all. You're just yeah.
Yeah. And a lot of times we'll do, I mean, there's plans that we'll use in conjunction with one another, right? We'll have a 401k with a profit sharing component and a separate defined benefit plan. And that's where you really max out, all three categories because the 401k has a maximum contribution limit of, $23,000 a year. I think it's 30,500 this year. On
7,500 if you're over 50.
Right.
Yeah.
So because of the catch up, if you're over age 50, the defined benefit plan can have up to $275,000, and that's based on some customized formula that a third party, administrator does. And
Right.
then there's the profit sharing plan, which allows you to take roughly 25% of the profits and put it away. And I'm sure there's a cap on that as well. But if you're in a situation where you're doing consulting or you're running a small business and you have a enormous income, those plans can be highly, highly lucrative. The big challenge is that what we see is that those defined benefit plans, if you've got more than a couple of employees, can get really expensive. The only way that it works is if you've got either very few number of employees or a highly transient workforce, because there are vesting stages put on the contributions to a defined benefit plan. And so if you put kind of the most punitive vesting schedule on, then you have to put the money in there for someone. But then if they don't stick around for it to vest, then you get to claw it back. So
Right, right, and you're exactly correct. They generally only work. I mean, I'm sure there's some circumstance that is we could draw up where it does work for a larger entity, but you're right. It's a small workforce, generally much higher earners. Generally, the owners of those companies are the higher compensated employees. And again, we go to attorneys, we go to doctors,
yeah,
people in highly specialized fields where that is really a great option. But the nice thing about them is we can usually do an arithmetic assessment of that. If we're expecting the contribution for their partners to be 150,000 apiece, and then maybe for the rest of the staff, it's 10, 15, 20, depending on their age and of course
right.
salaries. We can look what the tax savings is going to be. We can say, hey, yes, you're going to give your employees money. They're going to love it. And maybe you are saving more tax dollars from that than you have to ultimately contribute. And in a lot of scenarios, you are.
Yeah.
Of course, that has gotten more complex because the 2017 Tax Cuts and Jobs Act, we have qualified business income deductions,
Mhm.
which may or may not be applicable to these specific clients. We have income limits on those. But if you are what's called specified service business, they have hard taxable income caps on your ability to claim that 20% in non-taxable benefit.
Mm.
So what happens with that? I apologize. This is me, the CPA, just rolling forward and not
Yeah,
explaining
that's
what this
great.
is. We have what's called the qualified business income deduction. So when we did the 2017 Tax Cuts and Jobs Act, we lowered the C corporation tax rate to 21%. That's permanent tax law. It created an inequitable lack of benefit to the small business pass-through entities, your partnerships, your LLCs, your S corporations.
Mhm.
So Congress, in their infinite wisdom, devised what's called the qualified business income deduction. So up to 20% of that net income that floats to you might not be taxable. So you have
Mhm.
$100,000 that comes to you on a K1 from your partnership. You potentially 20,000, that's just simply a non-taxable item.
Mm.
Now, when you get above statutory income limitations on this, it starts to phase out. I think it's 389,000 in this year, but don't quote me on that. Um, so what happens is there are two types of business, qualified businesses, specified service businesses. So that's me, that's you, that is attorneys, that's doctors. There is no way around that statutory limitation for us. When we get above that taxable income, we get phased out of that deduction, and there's no way to claw it back unless we just simply make less money. But the nice thing about these defined benefit plans is, of course, that for people like that, potentially you can push them down, push their income down, them into that. But for other businesses, so if you're in manufacturing, you've got you're a retail, you're a restaurant, whatever. Those limit then become based on a wage base or unadjusted basis in assets. So 50% of wages or 2% of unadjusted basis in outputs placed in service. You could potentially get that qualified business income deduction up to unlimited income. But the point of all this is if you're making these contributions to these plans, they're potentially reduced, that deduction is reduced by that 20%,
Mm.
because effectively that is your net income. So just there's so much complexity to where we get to what is the tax effect of this deduction anymore. And again, now we talk about different limitations, and probably most of the people we're talking about that are making defined benefit plans are going to fall under that specified service business
Gotcha.
umbrella anyway. There
Right.
as well.
Yeah, that's good. That's really good feedback, Ian. I really appreciate the perspective today.
Sure.
Any other topics we should jump into before we wrap this up today, or you feel like we've probably given our listeners a lot to think about?
Well, it's funny. I feel like I could go on and on and on because I get so many different questions
Right.
from clients, and a lot of them are really, how can I save money? Hey, I'm starting this business. I want deductions. I want deductions. And, one thing I always tell people is like, look, you need to focus on making money first before you start worrying about, getting the maximum amount of deductions.
Right.
But, the one thing we all need to be aware of is the IRS has been granted $60 billion in additional funding. They're looking to bring audit rates up to 2012 levels with that funding. Frankly, we have seen more compliance notices. We have seen more audit. I think we would have seen that anyway in the absence of funding. I think a lot of that is the IRS clawing its way out of this post-COVID era,
Right.
because they had so much to do administratively with the CARES Act, the PPP loans,
Yeah.
and all the compliance that came with that.
Yeah.
But, so the important thing we need to do is ensure that with our businesses, we're appropriately documenting our expenses. There's a lot of, we talk about social media and the information out there, and you're talking about this information age and Google, and there's a lot of really bad advice out there.
Yeah.
And presently, the IRS is on the dirty dozen, which is for the 12 worst tax scams that are out there. One of them is listening to social media, and of course, this goes on social media. But listening to social media promoters, a lot of these finance gurus and whatnot, giving tax advice.
Yeah.
A lot of what they give, there is a hint of truth to it. It might work for specific taxpayers. For most taxpayers, it doesn't.
Yeah.
So when we talk about automobile deduction, that's a big one. Can I write my automobile off? I love that question. The answer is if you're using it for business, yes. But there's a big but with that. This is governed by a section of the Internal Revenue called Section 274D. You need to maintain contemporaneous substantiation for that. That means a mileage law.
Yeah.
The beauty of the modern era, we carry around the computer and GPS tracker in our pocket.
Yeah.
There are apps to do that, but you need to have it. So you use it for business. You need to track what client or business you're going to, what the business purpose is, and it needs to happen in real time.
Yeah.
That goes the same for meals. Everybody thinks they can just write every meal off. You can't. It's got to be a business meal. I mean, if we go to business, go to lunch with our client, got their CPA, the financial advisor, one of us picks up the tab, we can deduct that. We got to document who it was and what the business purpose was.
Yeah.
So
and it's like only 50% deductible.
And it's only 50% deductible. Absolutely. So, again, it's, if you've got a business, make sure that business has a business checking account. Make sure it has a separate credit card for that business.
Yeah.
Make sure you're using those business checking and credit cards for business purposes.
Yeah.
I've got some real cautionary tales with just that, because their immediate fear is the IRS, and for good reason. The IRS has a great deal of latitude to disallow things. Yeah. And it can be costly to fight them if you don't have the appropriate documentation. But frankly, where do I see a lot of my audits? I see them with the State Department of Labor. And they can audit almost any business. They want to make sure you're compliant. They're really just frequently looking for subcontractor issues. But through that, they're reviewing your entire general ledger. So if you've got personal expenses on there, they're going to ask what they're for. They're going to ask why 1099s aren't getting issued. And I've seen that happen. So, make sure your business is being operated with business expenses, business income, and your personal side, that's where you pay your personal side.
Right.
So, little things can make audits go quicker. They can make them less painful. They can make you less of a target. The IRS is hot on large vehicle deductions right now. And especially they're looking at, does this have economic substance? If you buy $100,000 Land Cruiser and you've got a $40,000 a year side gig and you try to deduct that, it's a fair question. Well, I'm using it for business. Okay. Well, how can you afford it? Well, maybe they didn't mention their spouse makes $1.2 million.
Right.
It doesn't really make economic sense for that specific business. If you are driving around, you're a contractor, you're a builder, and you're driving job site to job site, and you've got $4 million in revenues, there's a little more economic substance to that. I mean, it passes, for lack of better term, it passes the smell test.
Yep.
You can sit in front of the IRS auditor and explain this without even having to break the mileage law, but there is a purpose to it.
Right.
So, again, just thinking about these things beyond just well, I can deduct it. I'm using it for business. Well, yeah, but is it reasonable?
Yeah.
Does it have a purpose? So
Well, and I think the other side of it is that people will be penny wise and pound foolish on that stuff, on things like that. So on the mileage thing, so somebody will go out and they'll pay more for a heavier vehicle that's going to eat more gas, that's going to cost more to operate than what they otherwise would have purchased because I can write the thing off or I can accelerate the deduction. And then let's say they keep it for 10 years and they do put 20 or 30,000 miles a year on for the business. Let's say they are a heavy, heavy travel business. Um, they probably would have been better off over time writing off their mileage than writing off the vehicle up front.
absolutely. And you
So
know what? Mileage deductions are often a cleaner way to substantiate it because, it's based on a log. I mean, a
yeah,
mileage deduction means you've got a log that say, this is what I'm doing for business. And you're absolutely right. And to even further add complexity to that, the other thing business owners frequently forget or don't even know, um, 1031 exchanges. We hear a lot about them in real estate. Well, we have to because that's the only place you're allowed to do it anymore.
right.
If we went back to prior to the current tax code, you could 1031 exchange like-kind business assets. That business vehicles.
Mm,
So you have $100,000 bucket truck or a take body for your business. I mean,
yeah,
that happens all the time.
sure.
Um, you trade that thing in for a new one. You don't just get to kind of roll that old basis in the new one, which is effectively what you did with the old 1031. You have to claim that trade in value as a gain. So if
Mm,
you've depreciated that to zero and now it's still worth 60,000 on the trade, you've got $60,000 in income right there. Now
mm,
you hope the new vehicle is going to be able to give you a deduction to offset that. But hey, if you were to trade that in on our sub 6,000 gross vehicle weight rating vehicle, trade it in our passenger car, you're limited to 20,200 on that deduction in the current year. So you've got 60,000 phantom income, 20,000 in deduction. You've got a $40,000 delta of ordinary income. Big tax on.
mhm.
So, there's a lot of scenarios with this stuff that floats around social media. They're actually detrimental to the taxpayer. So accelerated deductions or depreciation rather is a wonderful thing. But we're also seeing that phase out too. So we had
Right.
100% bonus depreciation, went down to 80% last year. It's 60% this year. And then it's going to go down to zero ultimately in 2027.
No.
So we're left with Section 179, if applicable, if you're not above the asset limit. And then if you know that all the subsequent partners in an entity are also beneath that asset limit because those Section 159 limits come to the individual. So if you weigh in have a specific limit, I end up another limit.
Right. Right.
So anyway,
That's been something we've talked to some of our clients who are in the medical industry, and they sometimes they lease X-ray machines or dental equipment or things like that. And they there's two issues. Number one, they're not capturing the depreciation at the corporate level because they're leasing the asset and writing off the lease payment instead of the asset itself. Um, and the other side of it is that that's a payment that does not give anybody any ability to kind of discriminate within the partners. So we've had a couple of dentists, for instance, set up a separate LLC, buy the equipment in the LLC, and then lease the equipment to the partnership. And that allows them to capture the depreciation personally under Section 179. And now through the lease payment, they're getting, basically a lease payment that was equivalent to what they would have been paying. So there's no additional out of pocket to the business. The business is still incurring the lease payment, but now you're capturing the depreciation and the senior partners effectively acting as the bank. So there's an interest gain. There's a rate of return gain on that built inside that lease payment. So,
right.
so they're able to get, those two advantages. One of them's a tax advantage, the depreciation, and one's a cash flow advantage for being the
Sure.
bank. So,
Sure. Yeah, I mean, there's certainly a lot of different ways to structure asset purchases. It's one of those things we can really get in the weeds, but really it just comes down to to the individual, what they're looking to accomplish with those deductions. I mean, one of the things we come to deal with a lot when it comes to bonus depreciation, large asset purchases, and a great example are medical profession. I mean, medical equipment is ungodly expensive. It is
Yeah.
so expensive. Um, is determining how we want to use that deduction. We can make elections out of just setting 179, section 179 depreciation aside. We can elect out of bonus depreciation. So, well, why would you do that? Well, maybe the reality is this. This person's going to be in a top bracket each year. So what maybe we do want to spread it out. Because we have a sunset provision. Maybe it's a 5 or 7 year asset. We have a sunset provision in the tax code, and maybe we're gambling on the fact we're going to see higher tax bracket after. Maybe we know that this person hates this piece of equipment. They've talked to the manufacturer and they're trading it in on January 6th of the following year. I've had that happen frequently. I have that happen with vehicles.
Mm.
So maybe we are limiting that depreciation because we know we're going to have to recapture it next year. They're getting almost all of their original purchase price back.
Right. Right.
So there are reasons we elect out of that. Now that's a class level election. If you've got 5-year assets on the books and you elect out a bonus depreciation, and in the straight line, you're electing for every asset you're placing in service.
Mm.
You really have to think about it. You got to think about every partner involved, and if they're all on board with it.
Right.
So, yeah, I mean, ultimately, what does it come down to? I can go over 5 million little circumstances where, it really depends on what the client needs are, what they want, what's coming up on the horizon. Sometimes you just push people down into brackets with these big asset purchases, and you're like, let's not do this. 10 to 12% bracket. Why are we wasting these
That's
tax
right.
dollars
You got it.
for no
Absolutely.
savings? So,
Yep.
yeah.
Yeah, absolutely. The idea that we're pushing people down into the lowest income tax brackets when, they're going to end up in retirement paying more in taxes. So
Absolutely.
again, it comes back to lifetime tax liability, right? So that's and tax management, not tax avoidance. So
Absolutely. And it is one of those things where everybody tends to focus on the year in front of them, their quarterly estimates, and then that April 15th, potentially writing a check or what they're getting back. But you're right. I mean, what is your best strategy is to keep your tax liabilities generally pretty average year to year. You don't want large spikes in income. Maybe unless you're naturally a top bracket taxpayer, sometimes it doesn't matter. But you want to keep it low because that's going to keep your average tax rates year after year lower. Versus, and again, that's the same thing, and you've probably seen it as well, where you reach people that are 50, 55, 60, they're on the cusp of retirement, and you look at the potential return on their SRAs, and all of a sudden their RMD is larger than their wages were in the working years. Good problem to have. But it's still a problem. And how do you manage that? Do you take early distributions? Do you start looking at conversions prior to Social Security? I mean, that's a big one. Are there any pockets of lower tax brackets where you potentially convert some of that and avoid some of that R&D? Or, and of course, the other thing is qualified charitable or contributions to these to potential charities and whatnot to lower that when the time comes. So
Yeah, well, and we use that's another topic for a different conversation, but we use donor advised funds for clients as they're in their peak earning years, kind of moving towards retirement. If there's a philanthropic bent to their strategy and where they want to be and how they want to show up in the world, and in terms of the impact they want to make, we can use those top income years to shave money off the top in those tax brackets, move it into a donor advised fund, take the tax deduction in those years, and then set the client up with kind of a bolus of capital going into retirement. That's now they control the distributions. The money has to go to charity, but it's been, we basically spent the money while they were in the top tax bracket years. So
absolutely. And again, when you talk donor advised funds, I always say to your listeners, you need to consult professionals on those.
Yeah.
I know that goes without saying with anything that we any advice we give, but certainly if you're the demographic that is capable, able, and willing to do a donor advised fund, I mean, you should already have professionals of race to advise on that, because they are reputable. And that's one thing I always remind clients, because I have some clients they have misconception. I mean, they're different than CRUTs and QUARTs in
Yeah.
that
Yeah.
there is no potential to claw back any of that asset once it's donated. I mean, that now is in perpetuity is going to go to charity. I mean, if it's not coming back to you, it's not coming back to your children, it's not coming back to your beneficiaries. They may have the opportunity to control some of their charitable giving through it, but in no way can that fund any lifestyle and personal needs. So,
Right. No, that's good. Ian, this has been great. I want to wrap this up and just say thank you very, very much for taking the time today. I think there's a lot of meat here for our listeners. We're going to put your contact information for your email and contact information for the partnership in the notes for this section. Or for this episode. So thank you again so much for being here. And thank you, our listeners, for listening to the Envision More podcast.
Thank you for listening to the Envision More podcast with Wayne Wagner Jr. of Visionary Wealth Management. We hope you were encouraged and inspired by the conversation today. If you want to dig deeper into the show notes or Wayne's work at Visionary, you can find us at envisionmore.com. That's Envision with a Z. Advisory services are provided through Wealth Plan Investment Management. Wealth Plan Investment Management and Visionary Wealth Management are separate entities. The content is developed from sources believed to be providing accurate information. The information in this material is not intended as tax or legal advice. Please consult legal or tax professionals for specific information regarding your individual situation. The opinions and material provided are for general information and should not be considered a solicitation for the purchase or sale of any security. Thanks for listening.